Imagine for a moment, you've just pored over a company's financial report. The numbers sparkle, revenue's up, profits look, well, pretty robust.
It looks good on the surface.
Right. But what if, despite all that, the company is secretly teetering on the brink, maybe just months from shutting its doors? How would you, as an investor, maybe a potential partner, or even an employee, how would you ever know?
Yeah. What are the signs? What do the experts look for?
Exactly. What are those secret signals?
It's truly the invisible foundation, isn't it? This basic assumption. It underpins almost every number we see in those financial statements. Yet when it's unstable, everything else becomes kind of secondary.
That's the very bedrock we're talking about today. Welcome, everyone, to a deep dive into going concern. It's a concept so critical in finance and auditing, yet, often misunderstood.
Very true.
It's essentially about whether a business is actually expected to keep operating for the foreseeable future, or if it's maybe heading straight for liquidation.
Big difference there.
Huge difference. So our mission today is to unpack the crucial responsibilities of both company management and auditors when it comes to assessing this going concern idea. We want to help you identify the key warning signs that a company might be in trouble and understand exactly how these findings get reported.
And we're drawing this all from a single, really insightful source today, aiming for that clear, comprehensive understanding without, drowning in jargon.
Perfect. So let's unpack this. It sounds straightforward maybe, but it carries these massive implications for pretty much any business.
Oh, absolutely. What's fascinating, I think, is how this core assumption influences everything. From how you value assets to how you classify liabilities. It really is an intricate dance between management's judgment about the future.
Your best guess, maybe.
Well, an informed guess, hopefully.
Yeah.
But yes, their judgment, and then the auditor's meticulous scrutiny, looking far beyond just those surface numbers.
Okay, so let's start right at the beginning then. What exactly is this going concern concept? Our source explains it simply as the assumption that an entity will continue in business for the foreseeable future.
Right. And that phrase, foreseeable future, is actually defined, which is helpful. Under IAS 1, that's the International Standard for Financial Statement Presentation, it means at least 12 months from the end of the reporting period.
At least 12 months.
Okay. And it assumes the entity has no intention or even the need, to liquidate or significantly cut back its operations.
So if things look really bad, if management thinks, okay, liquidation or major cuts are unavoidable,
then they just can't use the going concern basis. Simple as that.
what do they use instead?
They'd have to prepare the financial statements on what's called the breakup basis.
Breakup basis. Sounds ominous.
It kind of is. It essentially values the company's assets at what they'd likely fetch in a quick sale, like a fire sale, rather than their value as part of a running productive business.
Wow. Okay, so that would look drastically different on paper, I imagine.
Completely different.
And the source makes such an important point here. This whole concept gets particularly relevant, particularly urgent during tough economic times.
Oh, yeah.
Because you could have a company that, on paper, looks profitable, but it could still face severe going concern issues purely because of, say, cash flow problems.
Exactly. Profit doesn't always guarantee survival, does it?
Yeah.
It really highlights that solvency, having enough cash to pay your bills, and liquidity are just as vital as pure profitability for a company's long-term health.
Right. Solvency and liquidity. Crucial. So if this assumption is so fundamental, whose job is it? Who makes the call first?
Good question.
The material we're diving into is crystal clear on this. It is management's primary responsibility. They have to assess whether using the going concern basis is appropriate when they prepare the financial statements.
That's right. It's not something the auditors decide initially. It starts with management.
Okay. But it's not just ticking a box.
Oh, not at all. Management has to make judgments about, inherently uncertain future outcomes. It's tough.
I bet.
Our source, and it draws from ISA 570 here, that's the auditing standard on going concern, it highlights 3 really critical factors that influence this judgment.
Okay. What are they?
First, the degree of uncertainty. It increases significantly the further into the future you try to predict an event or outcome.
Makes sense. The further out, the fuzzier the picture.
Exactly.
Yeah.
That's why having that specific time frame, the 12 months we mentioned, is so important. It sets a reasonable boundary.
So it's not just about time. Does the company itself, like its size or industry, affect how uncertain things are?
Absolutely. That's the second factor. The entity's size and complexity, the specific nature of its business, how sensitive it is to external factors like, say, interest rate changes or competition. All that significantly impacts the judgment.
So a tiny tech startup versus a massive established manufacturer, very different uncertainties.
Totally different ballgame. And the third factor, and this is crucial, is that any judgment about the future can only be based on the information available at the time the judgment is made.
Ah, okay. So you can't judge them harshly in hindsight if completely unforeseen events happen later.
Precisely. Subsequent events could always lead to different outcomes, even if the original judgment was perfectly reasonable based on what was known then. It's about the process and the info available at that moment.
That's a really critical distinction. It's not about having a crystal ball.
Not at all. It's about a reasoned assessment.
And if management does look at all this, and they determine that, okay, there are material uncertainties related to going concern, what then?
Well, the source is very clear. They must make adequate disclosures about those uncertainties in the financial statements.
No sweeping it under the rug.
Absolutely not. Transparency is paramount for stakeholders, although you can imagine that must be an incredibly difficult disclosure for management to make, knowing it could potentially spook the market or lenders.
Yeah, a real balancing act. Okay, this is where it gets really interesting for you listening in. How do you actually spot these potential issues? Because, like we said, on paper, things might look fine initially.
But these signals, these warning signs, are what experts are trained to look for.
Exactly. And our source gives a fantastic list, drawing from past scenarios. Things like significant growth in competition, that makes sense.
Right.
Or a sharp decline in demand for a company's products.
Yeah, those directly hit the top line, the revenue.
Right.
Pretty obvious threats.
But it goes deeper, right?
Oh, yes. The source also points to more internal, maybe operational issues, like a failure to reinvest in new product development. That suggests the company might fall behind.
Stagnation.
Right. Or chronic difficulties recruiting suitably trained staff. If you can't get the right people, how can you execute your strategy?
Good point. These speak more to the company's long-term health, its sustainability, not just this quarter's profit.
Exactly. And then there are the, let's call them, financial red flags. The ones that are maybe harder to miss if you know where to look.
Like what?
Like an inability to agree suitable financing terms with the banks. That could be a potential death knell if you need funding.
Uh-huh. Or, this one's interesting, making significant investments, say in new machinery, but funding it entirely using an overdraft.
Yeah, the source specifically highlights that because overdrafts are generally short-term, high-interest borrowing. It's like, as you said, trying to build a skyscraper using a credit card. Very risky.
Very unstable foundation.
Precisely. And compounding that, the source mentions things like delayed payments to suppliers. Maybe some suppliers even start withdrawing credit, demanding cash on delivery.
Ouch. That puts even more pressure on the overdraft, right? And just general cash flow.
Cripples day-to-day operations, potentially. And maybe the most direct signal of all, a cash flow forecast prepared by the company itself that explicitly shows its financial position getting significantly worse within the next 12 months.
Wow. If you see that, it's almost impossible to ignore.
Pretty hard, yeah.
The source then lists even more general indicators, things like an inability to pay dividends to shareholders.
Which shareholders definitely notice.
Or major losses or cash flow problems popping up since the reporting date. So stuff that happened after the balance sheet date, but before the accounts are finalized.
Very important that subsequent events, period. Also, consistently adverse key financial ratios. Looking at trends over time.
What else?
Indications that financial support might be withdrawn. Maybe the bank is getting nervous. Persistent negative operating cash flows, meaning the core business is burning cash, not generating it.
That sounds bad.
It usually is. Or major debt repayments falling due that the entity just, cannot meet. And let's not forget pending legal or regulatory proceedings. If they lose, could the claims bankrupt them? That's a huge uncertainty.
It really does feel like assembling a puzzle, doesn't it? Where all these different pieces start pointing towards the same, possibly grim conclusion.
Yes, if you connect the dots. These often aren't just isolated events. They frequently paint a cascading picture of financial distress. One problem makes another worse and so on. It requires really astute observation and critical thinking from anyone analyzing the company.
Okay, so management does their assessment, identifies these signs maybe, makes disclosures, hopefully. What about the auditors? What's their specific role in all this?
Right, the auditors. Our source emphasizes again, really clearly, it's not the auditor's job to decide if the entity can use the going concern basis.
Still management's call initially.
Still management's call. Under ISA 570, the auditor's core responsibility is different. It's to get sufficient appropriate audit evidence about management's assessment.
So checking their work, basically.
Exactly. And then, based on that evidence, the auditor has to conclude whether a material uncertainty exists about the company's ability to continue as a going concern. It's about independently verifying management's judgment, not making it for them.
And they can't just use a generic checklist for this, right? The source mentioned that.
Absolutely not. Auditors have to tailor their procedures to the specific risks and factors identified in each unique company situation. You can't audit a software startup the same way you audit a mining company when it comes to this.
Makes sense. And the source flags some common pitfalls too, like relying too much on just talking to management.
Yes, that's a big one. Inquiries and discussions with management are, of course, a necessary starting point. You have to ask them about their plans and assumptions.
Right.
But those discussions alone do not provide sufficient appropriate audit evidence.
Why not? Because management might be, well, overly optimistic. Or just telling the auditor what they want to hear.
Could be. Their intentions or explanations, while important context, need independent corroboration. You need evidence to back up what they're saying.
Okay. And what about written representations? Getting management to sign something saying everything's okay.
Similar issue. Written representations from management are necessary audit evidence. Auditors usually get them, but they're not sufficient on their own to support the going concern assessment. Again, you need more objective proof.
So auditors need to dig deeper. They need external confirmations, objective data. So what are some examples of those more robust, specific audit procedures auditors need to perform? Our source gives a few good ones.
Yeah, like reading the minutes of shareholders' meetings or board meetings. You might find discussions about cash flow difficulties documented right there.
Clever. Getting insights from their own records.
Or liaising directly with the entity's lawyers about any ongoing litigation. The auditor needs to assess the reasonableness of management's estimates of the outcomes and, crucially, the potential financial hit.
Right, not just taking management's word for it on the legal front.
Definitely not.
Yeah.
Evaluating the entity's plans to deal with unfulfilled customer orders, that's another key one. Does the plan seem realistic? Does it address the root cause? It speaks directly to operational viability.
Okay.
And obtaining and reviewing reports of any regulatory actions.
Yeah.
Are regulators imposing fines or restrictions? All these procedures are designed to either back up or potentially challenge management's assessment with independent objective evidence.
It sounds like a lot of detective work.
It can be. It requires professional skepticism.
So after all this careful assessment, all this evidence gathering, what does it actually mean for the audit report? The thing that you, the user of financial statements, actually see. This must be where the rubber meets the road.
It's absolutely crucial, yes. This is where the auditor communicates their findings. And they need to avoid what the source calls a scattergun approach. They have to reach a very specific conclusion in their audit opinion about going concern. ISA 570 basically outlines three main situations or outcomes regarding how the going concern assessment impacts that final audit report.
3 situations. Okay, let's break them down. What's the first one an auditor might find themselves in?
The first, and perhaps most common, is when the auditor agrees that the going concern assumption is appropriate for preparing the accounts, BUT. A material uncertainty still exists.
Okay, so the company can probably survive the next 12 months, but there's a significant risk factor hanging over it.
Exactly. In this scenario, remember, management must disclose this uncertainty clearly in the notes to the financial statements.
Right, transparency.
So the auditor's first job here is to check if those disclosures are, in fact, adequate. Do they properly explain the situation and the risks?
And if they are adequate, if management has been transparent and explained the uncertainty properly, does the audit opinion get qualified or something?
This is where it's nuanced. If the auditor concludes the disclosures are adequate, the audit opinion itself will actually be unmodified.
Unmodified. So a clean opinion, even with a material uncertainty.
Technically, yes, the opinion on the financial statements themselves isn't modified because of the uncertainty, provided it's properly disclosed. However, and this is a big however, the audit report will include a separate dedicated section right after the opinion paragraph.
A special section.
Yes, usually titled Material Uncertainty Related to Going Concern. This section does 3 key things. It explains the nature of the uncertainty. It directly cross-references the reader to management's detailed disclosure in the financial statement notes.
Pointing you right to it.
Exactly. And it explicitly states that the auditor's opinion is not modified in respect of this matter. It's basically the auditor shining a huge spotlight on that specific note, telling the reader, pay very close attention to this part.
Okay, so it's essentially the auditor saying, the numbers are presented fairly based on going concern, but be aware of this significant risk, and management has told you about it right here.
That's a great way to put it.
What if those disclosures are not adequate, though? Or even worse, what if management just refuses to make them?
Well, then the auditor can't give an unmodified opinion. If the disclosure is inadequate or missing entirely, and management refuses to fix it, the opinion will be either qualified or adverse.
Qualified or adverse, meaning?
A qualified opinion usually uses except for language, meaning the financial statements are okay except for the effects of the missing or inadequate disclosure about the going concern uncertainty. An adverse opinion is much stronger. It means the financial statements as a whole are misleading because the lack of disclosure is so pervasive. In either case, there will be an explanatory paragraph detailing the issue.
Got it. So inadequate disclosure leads to a modified opinion. Okay, that covers the first situation, appropriate basis, but material uncertainty exists. What's the second main situation the auditor might face?
The second situation is much more serious. It's when the auditor concludes the going concern basis itself is fundamentally inappropriate.
Meaning the company really isn't a going concern, and preparing accounts on that basis is just wrong.
Precisely. Our source gives a pretty stark example to illustrate this. Imagine a company owes, say, $10 million due immediately. The bank flatly refuses to renew the loan. They can't find any alternative refinancing anywhere. On top of that, maybe major legal action is imminent.
Sounds dire.
It is. And yet, despite all this, the directors refuse to make any disclosures about the situation and just proceed to prepare the financial statements on a going concern basis anyway.
Wow. In a scenario like that, where liquidation seems like the only realistic path forward,
Then the going concern basis is fundamentally wrong. It
Yeah.
doesn't reflect the economic reality.
so what's the auditor's opinion in that case? It can't be unmodified.
Absolutely not. In such a clear-cut case where the going concern basis is inappropriate, the auditor issues an adverse opinion.
Adverse. The strongest negative opinion.
Yes. It means the auditor is stating unequivocally that the financial statements do not present fairly or do not give a true and fair view of the company's financial position and performance.
And does it matter if management made any disclosures in this case? Like even if they mentioned some problems but still used the wrong basis?
Critically, no. The adverse opinion is issued regardless of any disclosures made. Why? Because the financial statements are simply prepared on the wrong fundamental premise. The whole basis is misleading.
That's a very powerful statement from the auditor. Okay, adverse opinion for an inappropriate basis. What's the third and final situation that ISA 570 outlines?
The third situation is a bit different. It arises when management is simply unwilling to make or extend its assessment of going concern, maybe for the full 12 months, even if the auditor requests it.
They just refuse to do the assessment properly.
Or refuse to look far enough ahead, perhaps. If this happens, the auditor has to consider the implications for their report. It's essentially a limitation on the scope of their audit work.
Because they can't get the evidence they need about management's assessment.
Exactly. They can't audit something that management hasn't properly assessed or documented. This could lead to a qualified opinion or even a disclaimer of opinion, depending on how significant the limitation is.
A disclaimer meaning they just can't form an opinion at all.
Correct. It's rare, but possible if the limitation is pervasive enough.
Okay. So quite a journey there. We've really unpacked the core concept of going concern. We've distinguished clearly between management's job and the auditor's job.
Identified those crucial warning signs.
Yes, the red flags you can look out for. And we've understood the different ways this all gets reflected in that final audit opinion.
Hopefully, you listening now have a much clearer picture of how these financial watchdogs, both management and auditors, assess the health and future viability of companies.
Which should really help you better interpret financial news, look beyond the headlines, and understand what might really be happening behind the numbers.
Definitely. And maybe this leaves you with an important question to ponder. Thinking beyond just the financial statements, what might be the real-world impact if these going concern warning signs are ignored? What happens to the employees, the customers, the company's reputation, if the business truly can't continue as expected? How might those issues ripple through the broader economy, affecting suppliers, local communities, the whole ecosystem connected to that company?
A lot to think about there, especially those ripple effects. Fascinating stuff. Keep digging into knowledge, everyone, and we'll see you on the next deep dive.